Friends, hello. In China, banks have always been seen as the safest place for money. Elderly people save their lifetime pension, young people save for their first home, and in the end, they all put it into the bank counter that looks solid. But in the last 2 years, many people suddenly realized the safe harbor is not safe anymore. A woman in a third-tier city went to a rural commercial bank to withdraw 30 yuan of her pension. The teller repeatedly asked what she would use it for. They either tried to persuade her to buy financial products or required advance reservation and limited withdrawals. Bank employees complain online. This year's year-end bonus is gone. I received more than 5,000 yuan less than last year. Behind these small stories hides a heavy reality. From big banks to small banks in China, money is starting to run out. Yet official data still tries to maintain stability. The latest report from the Chinese Financial Regulatory Authority shows that by the end of Q3 2025, Chinese commercial banks' net interest margin was 1.42% stable quarter-on-quarter, which looks stable, but it is the lowest level since 2005. At the same time, asset quantities are worsening. By the end of Q3, non-performing loans (NPLs) reached 3.5 trillion yuan, up 88.3 billion from last quarter. The NPL ratio was 1.52%, slightly up 0.03 points from last quarter. International experience shows that a bank's net interest margin should be at least 1.8% to make money. Below that, banks operate at a loss. Now, among 58 listed banks in China, 81% have net interest margins below the warning line. That means 8 out of 10 banks are losing money. In 2019, before the pandemic, only 6 listed banks were below the line, about 10%. In 5 years, it increased eightfold. This is like a person with a normal body temperature of 37 degrees C, but China's banking system is at 35 degrees C, and doctors say, don't worry, the temperature is stable. Is this really stable? At this speed, the system may go into hypothermia. Even more serious this year, commercial banks' net interest margins have been below the non-performing loan rate for 3 consecutive quarters. In simple words, banks' earnings are now less than the losses from bad loans. This inversion is a sign that banks' profitability is too low to cover bad loans. It shows banks' health is worsening and may indicate the whole banking system faces more serious risks. This problem is widespread. According to 2025 mid-year data, more than 1/5 of listed banks in China have this inversion. How banks make money? Banks make money by borrowing deposits at low interest and lending them at higher interest. Your deposit interest is the bank's cost, and the loan interest is the bank's price. The difference is the bank's profit. This is called net interest margin. Banks use this to cover costs in bad loans, so net interest margin is the main measure of profitability. The bigger the margin, the more money the bank makes. The problem: China's economy is in deflation. Companies and families don't want loans. The government lowers interest rates to stimulate lending. Corporate loans 3.5%, mortgage loans 3.1%. In 2019, both were 5.56%. Rates almost halved, so banks make very little from loans now. Banks' responses: banks have been cutting costs and even stopping normal withdrawals. Pay cuts. In the first half of 2025, average bank pay increased by 1,300 yuan, but this follows last year's cut of 5,300 yuan. Management pay cut in 2024. 33 out of 42 share-listed banks cut management pay, some by more than 82%. Closing branches, shrinking offices. The worst banks making it hard for customers to withdraw money. In Shenyang, a woman tried to withdraw 5,000 yuan from her husband's transfer and was asked for marriage certificate, household registration, and the sender's ID. In Hebei, a woman withdrew money for hospital bills and was repeatedly questioned. In Jiangsu, someone tried to pay 7,000 yuan school fees by mobile banking and hit a limit, needing offline approval. In Guangzhou, someone tried to withdraw 80,000 yuan cash but was denied because they didn't explain the purpose. In Changchun, a mother withdrawing her own money was asked to report to the police station. This is not normal adjustment. It's a sinking ship trying to save itself. For customers, it means the money in banks may no longer truly belong to them. Bad loans problem despite data being beautified. NPLs are 3.5 trillion won. In May, Nikkei Asia estimated its potential NPL ratio at 7.8%, far above the official 1.52%. Most risk comes from real estate. In the past 5 years, banks handled over 3 trillion yuan in bad loans each year. In 2024, it reached 3.8 trillion, a record high. Bad loans are not just numbers. From 2024-2025, Chinese banks show strange signs. Banks sell bad loans, and by mid-November 2025, 166 NPL transfer announcements were made, far above the 4-year annual average of 60-80 example. Bohai Bank sold nearly 70 billion yuan in bad assets. Guangzhou Rural Commercial Bank sold 18.9 billion. Minsheng Bank sold 5.4 billion in 5-year overdue credit card debt. Banks sell properties themselves. Agricultural Bank, Construction Bank, Bank of Communications, Lanzhou Bank, Jilin Rural Bank sell properties on Alibaba or JD platforms. Example: A Guangzhou house worth 2.4 million yuan starts at 790,000 yuan. Many properties get zero bids. Banks are forced to become landlords. They are no longer just lenders, but property sellers. This Shoxi sources real estate collapse. 2021-2025 100 cities house prices fell 42 months straight. First tier cities dropped 30-40%. Third and fourth tier cities nobody buying. June 2025 32,000 houses in judicial auction sold at 30% of value. Bank collateral is losing value fast. What was supposed to be gold is now just iron. Local government debt. Local governments borrowed for new districts, plazas, unfinished projects, empty industrial parks, abandoned high-speed rail stations. Official data: 14.3 trillion yuan in hidden debt. IMF estimates 50-60 trillion. These debts fall on banks. Example: China Railway Group vs Industrial and Commercial Bank of China. CRG owes ICBC 4.6 trillion yuan. If CRG doesn't pay, ICBC must buy new bonds. These are bad loans caused by the system, not the market. Deposits are silently losing value. Small banks and shadow banking first hit in 2024. Nearly 100 village banks disappeared. In first 3 months of 2025, 48 insured banks closed. They mainly lend to local companies and real estate. The riskiest loans are concentrated here. 2022 Henan Village Bank crisis showed bank runs are real, not just movies. If many provinces face this at once, no local government can stop it. Experts say systemic banking crisis is not one point, but multiple points at the same time. What could happen if platform debt defaults? Village banks run out of money. Developers go bankrupt. Auctioned houses fail to sell. NPLs rise. Net interest margins drop. Shadow banking blows up. Local governments can't pay wages. This chain reaction could trigger a China lemon moment. Friends, we must see clearly Chinese banks are not really banks. They are the CCP's cash reservoir. The government can hide unemployment, deflation, and local fiscal crisis, but it cannot hide bad loans forever. Financial chain reactions are physical. They won't stop because of propaganda. Once the first domino falls, all others will topple rapidly. We already see withdrawal limits, banks selling property, exploding bad loans, platform debt out of control, disappearing small banks. This shows the first domino is shaking. Time is pushing toward a critical point that cannot be hidden, delayed, or maintained. What do you think about today's topic? Leave a comment. See you next time!